Hi, I want to welcome you to today's webinar. Today's webinar is on accounts and notes receivable. We'll call this Accounts Receivable II for lack of something else. But what happens when someone buys from us and then some of what they owe us, they can't pay us, so they sign a note. So let's just go through some of those entries so we have a better understanding. So our assumption is here that we sold $100 to John Doe, so on account. So to record the sale, we go debit accounts receivable, credit sales. John Doe later pays us part of it, so we debit cash and credit accounts receivable. So that's to record a partial collection. Now John says he can't pay us, but he will pay us in 90 days. So he signs an IOU, which is what a note is. It's nothing more than an IOU. And so here John signs an IOU, so we debit notes receivable and credit accounts receivable. So customer signs note to pay off in the future. Well, any note, the thing to note is any note means that you're borrowing money and you're going to have to pay interest. So an interest rate has to be assigned to the note, and a due date has to be assigned to the note. So let's assume that the due date's in 90 days, and the interest rate that we'll use is 12%. Interest equals to principal, which is how much is due, times rate times time. John owes us $80, 12% for 90 days out of 360. We'll assume a 360-day years for math simplicity. That comes out to $2.40 for interest. The entry then, and notice now I got 1, 2, and 3 here. The entry is first is that John is paying off the note. So the first thing we want to do is get rid of the note. So we credit the notes receivable. Second thing is we have to calculate the interest revenue, which came out to be $2.40. And the last thing we want to do then is figure out how much cash we receive. We don't know that until we add up both the canceled note plus the interest revenue. So that's why I go 1, 2, 3. So that's $82.40. That's the simpler way of trying to journalize this if we do it in a particular sequence. So John Doe paid us. Then it would be cash $82.40, get rid of the old note $80, and record the interest revenue. But what happens if John does not pay on the due date? Then John is said to have dishonored the note. Dishonor means that we have to reestablish it as an accounts receivable. John may write a new note, which in case we debit notes receivable, credit accounts receivable for the new value. But do note that that will be a higher value because John owes us interest on the first note. So to record a dishonored note, same process is up here, but instead of cash, it's going to be accounts receivable because now John owes us that money. It's in general account unless he signs another note. So accounts receivable, notes receivable has expired, so it goes off the books, and the interest revenue has theoretically been earned. If John is, for whatever reason, let's assume John can't pay us, then we need to write John off, and we do that as we have done in the past, by debiting the allowance for doubtful accounts and crediting accounts receivable for the amount that is owed, in this case $82.40. So please note that when we write off J. Doe, that includes that $2.40 of interest because that is his new receivable balance. I hope this has helped answer a few questions with regards to accounts and notes receivable. I look forward to seeing you on the next video.